Welcome to Mortgage Map. If you are preparing to purchase your first home, you have likely heard about the wonderful tax breaks that await you as a homeowner. Real estate advertisements and well-meaning friends often talk about how tax deductions will make homeownership significantly cheaper than renting. However, tax laws have changed dramatically in recent years, and many of the traditional tax benefits associated with buying a home are no longer as powerful or accessible as they once were. It is essential to separate myth from reality so you do not make home buying decisions based on outdated tax advice. Today, we will explain the actual tax benefits available to first-time homebuyers. We will break down standard deductions versus itemized deductions, the mortgage interest deduction limit, property tax caps, and the mortgage credit certificate program, using clear figures and examples. Let us first clarify the fundamental rules of tax deductions and how they apply to the average homeowner. A common misconception is that buying a home automatically reduces your tax bill. To receive any tax benefit from owning a home, your total itemized deductions must exceed the federal standard deduction. When you file your taxes, you must choose between taking the standard deduction or itemizing your deductions on Schedule A. For example, if you are filing as a single taxpayer, the standard deduction is around $15,000. If you file as a married couple filing jointly, the standard deduction is approximately $30,000. This means that if your itemized deductions, including your mortgage interest, property taxes, and charitable donations, do not add up to more than the standard deduction, you will take the standard deduction. In this case, your home purchase provides zero additional tax write-offs on your federal income taxes. Since the Tax Cuts and Jobs Act of 2017 nearly doubled the standard deduction, the vast majority of homeowners, roughly 90%, now choose the standard deduction because it is larger than their itemized expenses. Therefore, for most first-time buyers with moderate home prices, the traditional tax write-offs of homeownership do not provide any actual monthly savings on their tax returns. Furthermore, even if you do itemize, you can only write off the expenses that exceed the standard deduction threshold. Understanding this baseline is crucial because many buyers enter the market assuming that every dollar they pay in mortgage interest or property taxes will directly lower their tax liability. In reality, the tax code is structured to reward only those with high mortgage balances or substantial local tax burdens. This difference can result in unexpected tax liabilities if miscalculated. Second, let us examine the specific tax deductions that you can claim if you do qualify to itemize. The largest homeownership deduction is the mortgage interest deduction. Under current tax laws, you can deduct the interest paid on a mortgage of up to $750,000 for a primary or secondary home. If you are married filing separately, the limit is $375,000. For example, if you have a $400,000 mortgage at an interest rate of 6.5%, you will pay approximately $26,000 in interest during your first year. This interest payment alone, combined with other deductions, could push you past the standard deduction threshold, allowing you to benefit from itemizing. The second major deduction is for state and local taxes, commonly referred to as the SALT deduction. This allows you to deduct your local property taxes, plus either your state income tax or state sales tax. However, the SALT deduction is strictly capped at a maximum of $10,000 per year, regardless of whether you file as single or married filing jointly. If you live in a high-tax state and your property taxes are $8,000 and your state income tax is $5,000, you can only deduct $10,000 of that $13,000 total. Additionally, you can deduct the cost of discount points paid to the lender at closing to lower your interest rate. If you paid $3,000 for 1 point to reduce your rate, and it is a primary residence, you can write off that full amount in the tax year you purchased the home, provided you itemize. Understanding these specific limits prevents you from projecting inaccurate savings in your annual budget. Finally, let us explore the most powerful tax tool specifically designed for moderate income, first-time buyers, the Mortgage Credit Certificate, or MCC. Unlike a tax deduction, which only reduces your taxable income, a tax credit reduces your tax bill dollar for dollar. The MCC is a program administered by state and local housing finance agencies. It allows you to convert a percentage of your annual mortgage interest, typically between 10% and 20%, directly into a federal tax credit, up to a maximum cap of $2,000 per year. For example, if you pay $10,000 in mortgage interest this year, and you have a 20% MCC, you receive a $2,000 tax credit. The remaining 80% of your interest can still be used as an itemized deduction if you choose to itemize. To qualify for an MCC, you must meet specific household income limits and purchase price caps, similar to down payment assistance programs. You must also apply for and secure the certificate through an approved lender before you close on your home. You cannot apply for it after closing. To navigate homeowner taxes successfully, follow 3 simple steps. First, consult a certified public accountant to estimate your tax position before buying. Second, check if your local housing agency offers mortgage credit certificates. Third, do not buy a home solely for tax benefits. By focusing on your monthly payment and your housing budget, you can make a sound financial decision. The MCC remains active for the life of your mortgage, meaning you can claim this tax credit year after year as long as the home remains your primary residence. This persistent credit is a genuine, repeating benefit that can make a substantial difference in your household cash flow over the long term. Mortgage Map is a calm guide for first-time buyers and curious homeowners navigating the home buying process. The channel explains down payments, interest rates, closing costs, pre-approvals, refinances, loan types, and common mistakes with real numbers and simple visual examples in plain English without financial advice or market hype. This video is general mortgage education, not financial, investment, legal, or tax advice. We are not a lender and do not recommend specific loan products. Mortgage programs, rates, and terms change frequently. Consult a licensed mortgage professional before making financial decisions.